Hey there. In this video, we're going to start looking at the bigger picture to understand what the lender is looking at when they're evaluating your loan application. These 5 C's of mortgage lending cover the entire picture of what they're looking at. The 5 C's of mortgage lending is a well-known concept because it really does give you a conceptual view of all the pieces of the loan approval process. Then let's dive in. The first thing the lender looks at, even before they get your income or your assets, they're looking at your credit. Now, this is generally referred to in the 5 C's as character. What is your credit history? What are your credit scores? What is your payment history? The vast majority of loans are going to be approved through an automated underwriting system, which means your credit is being reviewed by an algorithm. They're looking at your credit report and will either say yes or no to your credit profile. The character is really your credit. What does your credit look like? We will have an entire series on how lenders evaluate your credit. We'll do deep dives on concepts like student loans and things that are tricky because of the guidelines around how they are calculated from a debt to income perspective. Again, debt to income is another concept we will cover very thoroughly. I'm just dropping these terms and definitions as I go along. So number 1, character. Credit is usually the first thing they review when looking at your mortgage application. Secondly, capacity. As much as I said these are in no particular order, I do think I put them in a particular order subconsciously. Capacity is your ability to repay. This term was memorialized in the last, 15 years, because during the mortgage crisis, lenders had not demonstrated or documented that the borrower had an ability to repay. They were doing stated income loans, meaning you could tell me you had a job and you made money, but I wasn't actually going to make you prove it. So how was I documenting that you had the ability to repay the loan I gave you? I wasn't. And that was deemed irresponsible lending. Now, your ability to repay is something that the lender has to document and prove before they're allowed to approve your mortgage loan. So part of your loan process and you demonstrating your ability to repay is going to be you showing that you have a job, you have income, and stability in your job. This is a little subjective, and it does vary a little bit between lenders and between loan programs. Most of the time, lenders want to see that you have been working consistently for the past 2 years. Now, that can get a little tricky if someone is just coming out of school or they had taken time off for parental leave. There are a lot of situations where maybe you haven't been working for the past 2 years, but you're working now and your income will continue. So don't be discouraged when I say 2 years. That's just the most conservative approach. There are several situations where you could have just gotten a job yesterday and that would be okay as long as you could prove your income, you could prove you have a pay stub and get a loan. Capacity. Do you have a job? Do you have a documented ability to repay that loan? What's your income? How stable is that income? But those are the big picture items on capacity. Now we're going to move on to collateral. Now this is not really about you, but it is about the house that you chose. So collateral is referring to the home. So the home that you're looking at, that's the collateral piece. Why is that important? Because a lender is going to make sure that a home is in a particular condition before they're going to give you a loan to buy that home. So if the house is falling apart and the roof is caving in, they are not going to lend you money for that home, unless of course you're getting some kind of a fix-up or construction loan, which is a very special category with special requirements. But in standard terms, there's going to be an appraiser that goes out and does an appraisal of the home. And they're going to evaluate the collateral, one of the 5 C's. I do want to clarify, and again, I will cover this in another video very thoroughly. An appraiser is not an inspector. An appraiser is hired by the lender to determine the quality, condition, and value of the home. An inspector is hired by the buyer to look at the functionality of the home. An appraiser's job is not to call out flaws with the home. The appraiser is looking at an overall condition and whether or not it's safe for the lender to lend money on that home. So understand that there's an important distinction between an appraiser who is hired by the lender and an inspector who is hired by the buyer. And you don't have to hire an inspector. If you're buying a newer home and you don't anticipate that there are any significant problems with the home, you don't have to get an inspection. So just know that during your home buying journey, these are two separate things. The appraiser is hired by the lender and the inspector by the buyer. Both people are looking at the collateral, but the appraiser is looking at the collateral to make sure that it meets the lender's specific criteria. Number 4, capital. Capital is the money you have, your capital. How much money do you have in the bank? How much money do you have in the bank? Capital, or money you have in the bank, comes into play in 2 instances. Number 1, your down payment. And I told you about a down payment in the last video. If that sounds unfamiliar, please go back and listen to the previous video where I described down payment. That down payment is going to be a sum of money. I'm going to go ahead and tell you that most lenders require somewhere between 3% and 5% down at a minimum. You can always put more money down, but plan to put between 3 and 5% down. Those are average figures. Between a $400,000 house, your down payment would be at least $12,000 to $20,000 if you're doing 5%. That's your down payment. There are programs that help you with down payment assistance. There are 0% down loans. Usually, however, those loans are more expensive in the long run. They typically charge a higher mortgage insurance premium and or a higher interest rate. Be careful when selecting a no money down product or program. Look at the actual payment and do a good comparison. And of course, we will cover this in a future video at length because it's something I'm very passionate about. You pay a high premium to have no money down. I see people pay hundreds of dollars more per month to not have to put that 3% down. Whereas if they had put the $12,000 down in this case, they would have saved themselves $300, $400, $500 a month. So I understand that not everyone has the luxury of saving that much money. So I'm completely sympathetic. But if you do, it typically pays to not go the 0 down payment route because they really get you with mortgage insurance and a higher rate. Investigate those programs thoroughly. You need an estimate of your true payment rate and mortgage insurance are going to be before you get too excited. Capital, it's the money you have in the bank to cover your down payment. Lenders want to see reserves. Reserves are an amount of money that you have saved that can cover your debt for a given period of time. Most lenders want to see between 2 and 6 months of reserves in the bank when you close that loan after the down payment. You put your $12,000 or $20,000 down. The lender still wants to see you have 2 to 6 months reserves in the bank to cover unforeseen emergency expenses, maybe repairs to your home, you lost your job. They want to make sure that you have a couple months cushion in the bank after you close on that new loan. So what are reserves? Let's say your revolving debt on your credit is $500. Your new loan payment is $1,800. So if that's $2,300, 2 months of reserves would be 2 times that $2,300. Would be $4,600. Would be 2 months reserves. So reserves is a term specific to mortgage lending where they want to calculate how many months could you make your payment? What is your emergency fund? How many reserves do you have? Last condition. This is out of your control. When they say conditions, we're talking about market conditions. The market dictates things like interest rates. When the economy is bad, the risk of you losing your job or being able to find another job if you left your job goes up. So there's more risk when the economy is soft. Therefore, there is this element in mortgage lending that takes into consideration the conditions of the economy. It's important to understand that as the economic conditions change, the loan programs change to go along with the economy. For instance, when the economy gets bad, loan programs add more rules to protect themselves. Lenders reduce the amount of money they will lend. They're more strict on rules they might have been lenient on. They don't publicize it, but when the economy softens, banks tighten their lending criteria. And again, as I mentioned, most of this is happening automatically because your credit is being evaluated through an automated algorithm, not necessarily a human being. There are humans in the process all along the way, but automated underwriting is at an algorithmic level, and market conditions are programmed into that algorithm. And so just be aware of it, that as the economy gets tight, lending gets more restrictive. And that's not just with mortgages, that's across the board. I'm going to do a quick recap. The 5 C's of mortgage lending: character. They're going to review your credit, look at your payment history. And it's not just your score, by the way. I didn't say this in the beginning, but they're not just looking at your credit score. They're looking to make sure that you have credit debt. You actually have some active credit usage. That's actually pretty important. If you have an 800 credit score, but you haven't had a single line of credit or use of your credit in many years, that's actually not positive. Capacity is your ability to repay. Do you have a job? Do you have enough income to cover the mortgage they're asking for? And what is the stability of that job and income? Collateral is the quality and condition of the house meeting the standard of the lender. And again, I discussed appraiser versus inspector. The appraiser is someone the lender hires. The inspector is someone the buyer hires. Capital, it's the money you have in the bank, enough to cover your down payment and any reserves they want to see that you have in the bank after you've put the money down and after you've purchased this home. And lastly, conditions. What are the market conditions? What are the current rate? What is the risk of job loss, displacement, and the overall market conditions that might impact this loan and the lending criteria? Again, this is not something you control, but you should be aware of how market conditions impact the rigor of a particular lending product. I think we've covered everything in the 5 C's of mortgage lending. I'll see you in the next video. Drop me a comment and let me know how this video format works for you. I know I'm writing a lot and I'm moving the screen around a lot. So if that's off-putting or distracting, please let me know. I would love to hear your feedback. Thank you.